This program was brought to you by PennyMac TPO and Power Plus, their next-generation broker portal that gives you more speed and control over the process. You can now disclose, lock, and manage your loan seamlessly from start to finish, all in one place. It's another reason why greatness lives here.
Welcome to The Interest. I'm Mike Savino. If there's one thing that I do miss from the early days of the pandemic, it was the lack of traffic. With most people working from home, I never got stuck behind another car. But things are returning to normal, and that means more traffic jams. Securities backed by non-qualified residential mortgages are running into their own traffic jam right now. So what's causing this backlog? And will this be a problem for non-QM origination? Our own Christine Stewart has more from two experts who looked into the problem.
Many non-QM originators, not all, need to access the securitization market.
Non-QM loans have grown their share of the market in recent years, and that success attracted attention of investors looking for residential mortgage-backed securities. But now we're seeing a sudden slowdown.
So it's a good chunk of loans in these deals that could be called that's not being called.
A new report from rating agency KRBA found 27 non-QM securities have not been called, creating a backlog. But why is this happening? Just like homeowners, issuers are looking at volatile rates and deciding to wait. And the spreads for non-QM loan-backed securities, or the difference between the rate on the note and benchmark rate, is going up. Issuers then have to pay a higher rate to investors buying the redeemed security.
In the very beginning, if they go to refi, can they get a better deal now in today's market than they got 3 years ago when they issued this deal in the first place? And oftentimes the answer is no.
So what does this mean for non-QM origination? Funding could dry up, conventional lenders can always sell their loans to a government-sponsored entity, and jumbo loans are attractive to banks.
These types of financing options are not available typically to non-QM originators,
And non-QM lenders have a hard time finding funding. It obviously gets harder for originators to write these loans. So what has to happen for the market to change? We need the markets to settle and for spreads to shrink. But that's unlikely as long as the Fed is raising rates and selling off its balance sheet.
all of that and the speed of that is contributing to both the direction of coupons and spreads in the market and the volatility of those spreads.
You can hear more from KRBA and its study on The Principal, the Mortgage News Network's daily podcast, available wherever you get your podcast. For the Mortgage News Network, I'm Christine Stewart.
Thanks, Christine. With the housing market shifting so quickly, it seems some sellers are still trying to adjust and meet customers in the middle. A new report from Redfin shows us two things. Homes are, on average, spending twice as much time on the market as they were during the spring, when we hit a low of just 17 days. And that's leading to the most price drops since the start of the pandemic because demand is falling faster than inventory. Now, the median sale price is still up 6% year over year, but the typical home is now selling for 1% below the final asking price. Experts say this isn't a sign that home values will come down. Instead, the lack of demand is forcing sellers to come back to reality.
The sellers who got greedy, who could have sold their home for 20 or 30,000 above asking price, but shot for the moon and said, I want 70,000 above asking price. They are now seeing that not only has it come down to where they could have gotten, but below what they could have gotten.
Supply did rise to 3.1 months worth, the highest level since June of 2020, but that's still not enough to bring much price relief. And with mortgage rates hovering near 7%, most buyers are sitting on the sidelines waiting for affordability to improve. And that's allowing for buyers who are still in the market to ask for price reductions in terms like rate buydowns or getting the seller to pay for repairs. Coming up, how you can celebrate the best in the industry.
Don't miss the largest regional mortgage show in the nation. The New England Mortgage Expo returns to Mohegan Sun in Connecticut, January 12th and 13th. See us at www.nemortgageexpo.com. Start your year with the best connections in the industry. Dozens of sessions, scores of exhibitors. It's where success is written every hour. www.nemortgageexpo.com.
Welcome back. It's your last chance to help us recognize anyone who represents the mortgage industry with the utmost professionalism. We're looking to recognize industry titans, people who dedicate their expertise and years of experience to the mortgage industry. We're talking about professionals who go above and beyond to serve their clients and the industry. They don't normally seek attention, but here's the chance to give them the recognition that they deserve. Nominations are due by the end of today, and self-nominations are welcome. Just go to nmplink.com/Titans. Honorees will be showcased in the January 2023 issue of National Mortgage Professional Magazine and on this program. We'll be right back with what else is interesting today.
This program was brought to you by PennyMac TPO and Power Plus, their next generation broker portal. Visit tpo.pennymac.com to sign up.
Here's what else is interesting today. New Jersey-based PHH Mortgage Services will have to pay out $2 million for refusing a homeowner loss mitigation during a divorce. PHH is a subsidiary of Ocwen Financial Corporation. Lawyers for the homeowner say she tried for 5 years to get loss mitigation as provided by federal law and Freddie Mac guidelines. But PHH eventually sued her for foreclosure in 2018. The arbitrator said in her decision that corporate actions and indifference, when practiced to the harm of a targeted group, can easily be described as malicious. For more on these and all of today's top stories, go to mortgagenewsnetwork.com.